Hi, good morning, everyone. I think it'd be good to start now. Uh, we are at an interesting time right now in the markets, obviously. The number of times over the last 15 days, I think that I've heard people say that, uh, the markets are up, but our portfolio is either going nowhere or are down. If we would have got a rupee for that, like for the last 15 days, we didn't we wouldn't have to invest, I guess. So that's the stage that we are in. And let me share my screen. Uh, do let me know if it's visible. Thank you. So right now we are at a stage in a market where we are still on Goldilocks scenario. The Indian economy is doing well in terms of GDP growth being quite high, in terms of inflation being quite low. But there are obviously certain cracks that are beneath the surface, which we need to acknowledge. However, worldwide, we've seen that liquidity has been kind of either coming on or going off. It's been somewhere in the middle. So that's the topic for today. In terms of liquidity, is it there or is it not there? And we'll delve more into it and figure out how and what it means for the portfolios and the markets. Just a standard disclaimer to start with. Securities investments in securities markets are subject to market risk. Any example that we share here today in terms of stock names, we do not have a recommendation on it. There is no buy, sell, hold recommendation on anything that we discussed today. Any performance that we show is just for example purposes, and markets move in cycles, so performance also varies across cycles. So what happened in November, the November report card? Last month, while across the board, given there were a number of concerns, one with valuations in US, and second again the liquidity factor, markets across the world have kind of trying to find either a bottom or trying to, they've been range bound as such, and they're either trying to find a bottom or looking for conviction to kind of go up. In that sense, when we compare the broader, like the main index for India, we've performed better than China and US, even in terms of the last 3 months when we kind of turned quite positive on India. Indian main index has kind of done better than US and China. Over the last 6 months, India still remains a laggard when we compare it to China and US. From a longer term perspective, again, India and US are kind of neck to neck as we see post COVID. And China is the one that is kind of a laggard here. In terms of fundamentals, US, again, we wait for kind of official data after the government shutdown. But the ones that we are getting in, it looks like that, again, the Fed is kind of torn between kind of, again, if you look at Fed, they have a dual mandate. They have a mandate, one, to keep prices low, and second, to ensure maximum employment across the country. They're probably torn between the two. One, prices in inflation in US is kind of going up, while unemployment rate is also going up. So till now, till like I think October, Fed was more concerned around inflation rather than employment data. So when inflation was kind of there, they were kind of holding back. But now employment or unemployment rate has become their main focus, and inflation has kind of taken a kind of a backseat for the Fed. So given this circumstances, we saw Fed cut rates last like end of October as well, despite not having data due to government shutdown. And they were just concentrating much more on employment at this stage right now. Given the meeting, upcoming meeting, the market, the prediction market, which is the poly market in the US, is predicting around 90% people are predicting a rate cut of 25 basis points in the US. Given that, I think liquidity again should start making a comeback, and Fed is also pouring in liquidity from different means that we'll see later on, and that should kind of revive back some bit of the markets. Again, when we actually look at the bond market in terms of bond yields, they are not buying any of these rate cuts. They refuse to come down in the US, and that is something that one needs to look out for. When we look at UK and Eurozone, we'll take both of them together. There, the future predictions or the early indicators, which are the purchasing manager index, those kind of have started going up, but that's not being reflected in that GDP growth. However, inflation for UK and the Eurozone is kind of coming down. Um, although although they are not very, like, they are not within their central bank's ranges, and hence we are keeping stagflation risk at this point of time. In terms of China, China is peculiar in that regard. China was a country that was going through deflation kind of a thing where you had negative inflation. They have now moved to positive inflation, which is a good thing. When a country wants to grow, you should have some bit of inflation. Although 0.2% inflation when China is growing at the rate that they are growing around 1.1 looks to be good, but GDP growth when we started the year, China was supposed to grow at around 5 odd percent. If they grow at that rate, I think inflation should kind of make a comeback over there as well. Japan, we spent a lot of time on Japan, like I think in the September map session, and then that is one that is kind of driving that liquidity factor, and we'll just look at that as well. There, the GDP growth has kind of gone back to negative, although the wage growth is continuing to go up. So that economy as such right now is kind of facing a negative GDP growth and a higher wage growth. So inflation is also making a comeback while you don't have a GDP kind of a factor in there. So again, valuations also look stretched in Japan. However, there has been some dip in the market this month for Japan, and we'll see how we're positioning ourselves for that. India, again, as I said, as I began the conversation, India looks like the outshining, like the standout economy as such, where PMIs are holding up, where GDP growth is there, and inflation is probably at an historical low. The headline number is at an historical low. Given all of this, we continue to maintain our weightage and continue to be overweight India and positive on India. So let's just address what's the problem here in terms of what is driving the markets to be kind of in a very range bound manner, and your portfolios trying to figure out where to go. The biggest risk at this point of time is in terms of liquidity. Let's not kid ourselves. Post tariffs, the major rally, the one that you've seen in the United States, is majorly because of liquidity being driven in terms by Fed. Now we are kind of facing some headwind over there, and that headwind is coming through Japan. When we look at Japan, and if on the left hand side you see this is the Japanese yen and the US dollar chart, and on the right you see the Japanese 10-year bond yields. When you look at Japan, the over the last many years, there has been a particular trade that has been going on. So when you look at Japan across the last many years, the rates in Japan were quite low. So one could kind of borrow in Japan and then invest into other countries where the rates were higher. This is called the yen carry trade. And it makes sense when rates in Japan are low and interest rates other outside are higher. Now we are in a scenario where the Japanese government or the Japanese central bank is the Bank of Japan is increasing its rates, while the Federal Reserve in the US is trying to cut rates. So you have a scenario which is not very good for that yen carry trades, because your rates in Japan are going up and your rates in US are coming down. So you can't borrow, you can no more borrow at lower rates, and you can't invest in a country which is at a higher rate. So that yen carry trade is kind of creating that kind of a liquidity risk. And along with that, your Japanese yen is kind of trying to devalue itself as such. Once an unwind of yen carry trade takes place, and this was a major risk that happened in 2024 as well, generally your yen kind of tries to strengthen itself against the dollar. So this particular chart here should, let's say, if the yen carry trade were to unwind, the yen would kind of strengthen itself across the dollar. So what, like, do we actually think that a yen carry trade would take place? We think that maybe one round of yen carry trade took place in August of 2024, while generally post that again you've started have had a build up on the yen carry trade. And now we think that as liquidity, as the rates in US, as the rates in Japan, kind you will have another round of possible yen carry trade unwind. So that's the risk, that's the liquidity risk that we are going through right now, and that's making portfolios range bound or drift lower. So what should you do in that case? You should obviously rebalance early. So you should move to the idea right now is to build portfolios that have quality as a big factor in them. If you're going for companies which are highly overvalued or companies that you're just going after growth stories, those are the businesses that will take a big hit, because these are the ones that are kind of driven by liquidity a lot more. And in that case, your portfolios would take a larger hit in terms of if liquidity was to dry away from the markets. Obviously, this is the one side of the story where the liquidity is drying up. There's the other side of the story where liquidity is being pushed through. So this is the push and pull effect that is kind of driving the portfolios in a range bound manner. So who's pushing up liquidity? The US Fed is kind of pushing up liquidity. If you look at these overnight repurchase agreements, the these are the repos that are being these are the repos being bought on by the treasury. Here, outside outside the COVID crisis, the treasury has never bought this large factor of repurchase agreement across its history, in at least in this decade itself and across history. This large number of repurchase agreements were never bought, and this is the one that is kind of driving liquidity in the positive sense. Like, liquidity is being driven into the markets. So one side you have got that yen carry trade unwind that is trying to suck out liquidity from the market, and this is the one that is trying to push in liquidity into the market. Again, the reason for range bound kind of portfolios and markets. Does liquidity drive markets? What we've seen is that if you look at here, the white line here is the money supply in the market, and the yellow line here is the S&P market as such. So if you kind of look apart from the COVID fall that we had, S&P kind of follows the money market, or the supply in the market, the money supply in the market, and we've seen almost very good correlation when it comes to liquidity and the performance of a market. So if liquidity is kind of up, you could expect the markets to be up. If liquidity is down, there is stress everywhere. And right now we are in that perfect push and pull kind of scenario. So when we are at the push and pull scenario, I think we should kind of think of volatile markets. But when we think of volatile markets, this is what we said across the year, that markets would continue to be very, very range bound, just like a median year. So when you kind of look at a median year, so what we've done is we've gone through entire last beginning of 2008 till 2024. We've mapped out how each year, each month and each year looks like, and then we mapped out all these thin lines that you see at the background. These are the kind of years that we've had, right? And then we found out that what kind of a typical median year looks like. If all this noise was taken out from the markets, how would a typical median year would look like? And from the beginning of the year, we've been saying that this year would not be very different than a median year. And that is how it's followed, actually. Obviously, we don't expect the markets to follow exactly to the tick. Then there would be absolutely no returns to be made as such. But the volatility in the market has been that whenever it has dipped higher. And whenever it has pushed up higher as such. So it's been volatile, but it has kind of stayed around that median year, despite all that we have seen this particular year, be it tariffs in April, be it the Zelensky meeting in February, be it the tariffs in April, be it India-Pakistan geopolitical conflict in May, June sometime. Post that you had the Middle East crisis. So all of these factors still could not, they did not deter the markets away from that median as such. So we did not see any sharp movement kind of away from the median. But when you stay and when you rotate around the median, the markets become much more choppier. So that's what we are seeing right now. The market's trying to find strength at trying to find that a strength at a support and basically facing resistance or selling off from a resistive area. What does this tell us? That this tells us that when we are as we are moving into this particular new year, we believe that after a median year, the volatility in a market kind of slightly increases. Where it would increase as such, we'll come back on that later on in the slide. But keeping some bit of cash ready when the market is testing kind of support zones has been the idea that we've gone around across this year. So whenever the market has been kind of hitting a support area, we've been happily or very readily kind of deploying cash there. And when it's kind of going and hitting a supply area, we're taking out cash and we're selling and taking out cash and keeping on liquidity as such. So that's the one that has worked out till now. Another volatility, and this is what I think a number of people have been telling us, it is that markets have been at record highs. Nifty is kind of touching the record highs, but our portfolios are going nowhere, or our portfolios are down some XYZ%. And the idea here is that you're not just the only one. So the problem here, what we've realized is that everyone has this kind of an issue, but they are thinking of their issue in a silo method. So just feeling that probably our portfolio is kind of going through a difficult time. This is not kind of just a silo issue. This is a broad-based issue. The broad-based issue that we figured out here is that the total number of shares we figured out listed in the market for our sample set is 5,241. The number of companies that are down 10% are 4,000 or almost 89%, 4,655 companies are down around 10% of the market. Around 3,000, almost 4,000, 3,955 companies are down 20%. So almost 75% of your companies are down 20%. And similarly, almost 57% companies are down 30%. So again, and there are a few, almost 2,000 companies which are down around 40% or more. So while those which are down 40% and more or 30% and more, obviously one has to go out and check for whether they are quality businesses, whether one should hold on to them or not. But the idea here, when we kind of look at this, is that this rally has been very narrow in terms of we are hitting the market, or we are hitting all-time high at a very narrow, just a few drivers or money rotating very fast between sectors and companies. So that is what's happening kind of at this point of time. It is difficult to understand where the money would be flowing in, and it's happening so fast at this point of time that even if you figure out that there is money flowing into a particular sector, by the time that one figures out and tries to deploy money, the money has moved on to another sector. So that's how fast money is being rotated around sectors. Is this a good thing? Is this a bad thing? Obviously, everyone would like to have had a broad-based rally when we were hitting highs, but the frustration and the pain that retail is going through right now is just testing conviction as such, whether we should kind of break out to fresh new highs or not. And how we are placed is what we'll figure out in the coming few slides as well. Just a word on basically how the global business cycle has shifted in 2025. Before I move on to this slide, I'll just take a pause here and I'll ask if there is any question that anyone has till now. Yeah, Harshil, please go ahead.
Yeah, Karan bhai, so in one of the slides, you talked about PMI, GDP, and inflation. So
Yes.
these numbers come in every month?
Achal bhai, no. So some of these come in every month. PMI data that we get is kind of monthly. Inflation and GDP kind of we get it quarterly for India. For other countries, there is an estimate that comes out. So they give an estimate. So let's say we are looking at a particular quarter. Let's say quarter one. So quarter one, let's say if it's a calendar year, if it's January, February, March, then we'll have the GDP estimate for January. Then we'll have what the GDP estimate for February, and then a final GDP number for the entire quarter. So what we use here is an estimate number for that particular month wherever is available, and for wherever a quarterly number is available, we've used the quarterly number.
Okay, okay,
Okay.
fine.
Thank you for the question.
Yeah, thank you.
Cool. Sorry, Achal, you had another. Okay.
Karan, Navneet here.
Yeah, Navneet, go ahead.
Quick one. Here, based on your previous slide, you said either of these things happening, either very narrow base sort of rally, which means that if you're only in that 10% of the space, you would have made money, else you would have not made money, or the churn in the profit making, and I say profit making from a stock valuation perspective. Companies is so high that it's very difficult to cash flow of that particular thing, right? So given this scenario, aren't we just better off being in cash? Right? Why deploy in the market at all?
Sure. One could stay into cash. Again, a very, very good question. And this is again a question that we've kind of come across a number of times. The idea here is that by the time that we'll build conviction as to whether this is a good rally, the markets would have moved up by around a 10% or not. And by the time that we build in conviction, or the larger public has built in conviction, we would then be deploying into markets that would be probably range bound again. So the idea is again that equity markets don't generally just keep going up, and they take a pause, they test your conviction, and then move up. What we expect the move up will be probably a much more sharper move as such. One that if you're setting out, it would be probably a little bit, the conviction would build in probably a little bit later than so again, being on cash right now runs the risk of being missing out that sharp
Sure.
rally that would probably come.
Sure, but Karan, if you look at the math, let's say we are very good stock pickers and we pick up the top 20%,
Sure.
right? I mean, that's what a good, I mean, being in the top 10% is going to be extremely difficult. 20% is what a good stock picker will do, right? Which means if you're in the top 20%, 10% of your stocks would have made money, 10% of your stocks would have, 50% of your stocks would have made money, 50% of your stocks would have been down.
Sure.
So net will be close to 0%, right? Assuming that there will be very few stocks would have very sharp rallies.
Sure.
Given that, even if I missed the first 10% of the rally, which you just stated,
Sure.
I would have made 7 to 8% in cash. So then in the year, right? In the first year that we have not invested.
Sure.
So effectively, for the risk that I'm taking, I'm getting an additional 2 to 3%. Right? Is my math correct? If my math is correct, is the risk that we are taking for that additional 2 to 3% right or wrong?
Sure. So let me answer this by this. If you're in that top 10%, or if your portfolio is in that top 20% stocks that you've selected, and if the movement around here, let's say the conviction was built after around, let's say 7 or 8%, you're probably in the better slot or you have good stocks into your portfolio. Those are gonna move much higher. If you were sitting on cash, as you said, you would probably make 7-8% across the year. And if that rally is supposed to be sharp, then it probably would not give much more time. Think of this. What I understand here is that if we go back and look at the markets, if just give me a second, I'll just open up a chart. ignore the few markings that we've done here. These are that we use one for the chart as well, which will come later. But if you kind of look at this and this kind of this particular structure that we've seen here, it looks pretty much. So if I were to just, okay, all these lines are deleted now. So if you were to look at this particular structure, this one, and if you were to overlay this, I think the structure looks pretty much similar to this one. What we are doing here is probably, again, either we're probably here somewhere. And this rally, probably uptick rally was probably very, very sharp that we saw that here. Once we entered into this phase, the up movement was pretty sharp. I think, again, I think we kind of done all of this, and we're looking for something of a market like this. When that rally will become very sharp, the amount of days that will go across will be very small. And if you're in that top 20%, in the top 20% of the stocks that you've selected, if we are a very good stock picker, then the amount of return that we kind of land up is pretty good. The flip side of this, the risk on this is very, very important. If we are invested only in cash, if we stick right now only in cash, then what would happen is that your stocks, which are good, would have ran up quite a bit. Would you then, the risk reward on that would probably not look, you would want, the ideal psychology of a person would want a dip on those stocks, which would probably never come. So you would have to then have enough conviction and enough courage to buy into a breakout rally, with probably a stop loss or kind of the risk being much lower in that sense. So right now, in terms of risk reward, if a certain kind of, and as we'll come through on the charts as well, if a certain particular demand zone is being beaten down on that side, we know how much risk we are kind of taking on a particular trade. So I hope that would be able to answer that question. I don't know how confused you are.
Sure. Thanks. No. Thanks, Karan. This is helpful.
Okay. Sure. I think Omkar had a question. Yeah, you've raised it.
Yes. Good afternoon, Karan sir.
Good afternoon.
Also from IMT 2021 batch.
Sure, Omkar.
It feels good to be here. Just one question.
It's a pleasure.
Regarding the slide in which you mentioned liquidity against market return, right?
Right.
So, is there any way or any index, let's say, regarding liquidity that we can track to figure out that, let's say, an ongoing rally is because purely of the liquidity or not, apart from the repo rates?
One of the much more easier ones. Another rate that we figured out very recently, and that those are the ones that are making a lot of sense as such, is there is something called SOFR rates that you can look at. So these are secured overnight financing rates in the US. So generally the idea here is, I hope to get, just give me a second. I think we'll get, yeah. So these are the SOFR rates. So you could track this as well. So again, these are rates, remember. So whenever rates come down, that means liquidity pushes up in the market. So whenever rates kind of go up, that means, and these are overnight rates. So these are like just, very short-term rates. If these very short-term rates are kind of dipping down, then effectively you are in a liquidity-driven rally. If these short-term rates are kind of going up very fast, then liquidity is being pushed out of the system. This is one of the rates that you could kind of follow to figure out if there is liquidity in the market.
Right. And just a follow-up questions. This M2 money supply and SOFR rates.
Yeah.
These are US specific, or for India, is there something different we need to track as well?
For India, you could take care of the bond yields, basically the India 2-year, India 10-year as well. You can track the M2 money supply as well. Let us go back and figure out if there is another way of looking at liquidity in India. But generally, the liquidity driver in markets we figured out is the US market, which generally drives liquidity across the world. So those are the rates that we kind of track. In India as well, similarly, you could track the 2-year Indian rates, and you could track the M2 supply of money supply in India. But apart from that, we've not, at least I'm not aware of, at this point of time, I'm not aware of any other liquidity drivers or tracking methodologies, at least in India.
Okay. Okay, sir. Thank you.
Thank you. So just we'll quickly move forward into how business cycles have moved across this particular year. So at the beginning of January, when we came out with our annual report, we could see that almost all of the countries were clustered in a particular late expansion, mid expansion to kind of late expansion zone. So most of the countries were kind of here. Given that we've had and very divergent moves in the global banks, central banks across the world, these countries which were almost clubbed together, almost at the same cycle, they've kind of moved away by the end of the year. This is where we are right now in terms of where each country is in their business cycle. So I think India has stayed where it was. India is still in an expansion zone. Mid expansion is where we are placing it. And the one that has made a major move is basically Japan. Japan, which was kind of almost ending its expansion zone and moving into a contraction zone, has kind of, because they have given away the yield curve control and have started raising rates, have adhered or the inflation risk, they've kind of moved back into a recovery to an expansion zone. So this is a major move for Japan, and they've kind of brought themselves back to being one of those large economies or developed market economies that can probably say a lot or will have a lot of say in what happens in the future. Apart from that, I think others have kind of moved along the way. So US and Australia, all of them have kind of moved. The general cycle would generally, we would want companies to kind of follow this particular sine wave as such. So that's the normal move that happens. Eurozone, in one sense, Eurozone has had a very, very difficult year despite their markets being quite up. We're not convinced on Eurozone or UK. They have kind of slipped very fast into a contraction zone here. So this is the red zone probably here. They've moved themselves very fast away from an expansion to a contraction zone. So this is how business cycles have moved in 2025, despite, like, given all the pressure from tariffs and geopolitical tensions that have taken place. Where are we in the larger scheme of things? And this is one major cycle that we've kind of, if you're invested with us, you would know that we kind of taking this much more on. This is the last 115 years of larger cycles that we think about. And if you're invested with us, you know that we are quite bullish on the commodity story, and in that, metals and other hard metals, precious metals, and other soft commodities as well. What we've looked around here is that when we look at US yields, the 10-year US bond yields, over the last almost 115 years, it becomes quite evident that for a particular period of time, these rates kind of come down, and then for a particular period you have large spikes in rates upwards. Then you have another period of a downward move in interest rates in the US, and then you have interest rates go up in kind of again we've started looking at interest rates which are higher than kind of normal. So what does interest rates lower mean? Lower interest rates mean that liquidity is quite easily available in the world. When interest rates are high, money is not very easily available in the world. Again, when interest rates were low, money was quite easily available. And now money, although being pushed through different methods, it is still very difficult to come by. So when the liquidity is high or the interest rates are low, we call that era a technology era. Whenever the liquidity or the interest rates kind of start going up, we try to call that era a commodity era. What happens differently in these two eras is that because money is very difficult to come by in an increasing interest rate scenario, the innovations that we make are a long-lasting innovation in that nature, where we are kind of looking at where we are looking at innovations that use or which take proper use of money. One, money was very difficult to come by. So you're now using this money in such a thing that would have a long lasting kind of an effect. In a technology era where money is very easily available, you would want to use those innovations that were made in a commodity era and try to make them faster. So one very clear example was that between 1950 to 1985, we built the large supercomputer and all of that. When and again when you say space race and others as well. So in that era, when money was very difficult available, you created a system which was kind of which or you created an innovation that would have a long lasting effect. Now when the money is very easily available, you take that innovation, so you take that supercomputer and try to build speed around it. So you build your personal computers. Everyone has a laptop or a mobile phone in their hand. You have that, you have everyone connected through internet, through your fibers and through your optical fibers and being on the net, just data being very quickly available. So you make those large kind of innovations in a commodity era, and you take those innovations and build speed and scale around it in a technology era. So once that happens, we expect again, if we are moving into a commodity era, and when this last commodity era took place between 1950 to 1985, your metals across, again, there the scenario was slightly different. It's not very similar right now. There we were coming up after a major world war. So you had reconstruction also take place. Right now, we're not coming out from a world war, but we have two large economies trying to build development very fast. So again, here metals are very much in use. Also, one thing that we've noticed that during a technology era, commodities do not get any capex. So there is always that kind of whenever we move into a commodity era, when we want to make meaningful kind of innovations, and because capex was not done in the previous technology era, there is a higher demand for metals than the supply that is available. So when that supply demand mismatch happens, there's a large scale of there's a large movement in terms of those metal prices. So again, this is something that we've been very positive about, and if this similar pattern was to follow, we generally see that these eras are of around 30 years. And if we assume that this era of commodity started, let's say, from the COVID fall, then we are almost 20% done in this particular cycle. There's a larger cycle yet to come. So given all of this, we kind of stay invested, or we kind of still are kind of invested in our metal story and other commodity stories that revolve around this. Also, one thing that we've seen is that inflation across the world is also cyclical. So here we're talking about cycles. We've started with the business cycle. We then moved on to the commodity cycle. Now, the other cycle that we also track is an inflation cycle. This inflation cycle, generally, if you kind of look at it, they go up and down in terms of certain particular years, and there are flip years in the middle. So what we've kind of done is that we've taken the actual percentage, and this is US inflation trend. We've taken the actual inflation, and then we've done a 5-year rolling. So whenever you have this kind of large move away from the general trend of the last 5 years, you say that you are in an up cycle of an inflation. Whenever you are kind of below the rolling returns or rolling average of the inflation, you are in a down cycle of inflation. So generally, what we saw that starting again from the same time, that we saw the commodity, like the interest rate cycle, you had a down 15 years in inflation, and then you had a 15 years up cycle in kind of inflation. Again, you saw a 50 and almost an 18-year kind of an up cycle. Similarly, you saw an 18-year down, and then the 2008 crisis where US kind of pushed in a lot of brought down interest rates to zero, and you had this particular large massive unemployment across the world. The inflation cycle was broken, but still then we saw that another 10 years of up cycle of inflation and another 10 years of down cycle of inflation. Probably we moved up again in inflation post COVID. We saw here that there was a large revenge bought around, and again at that point of time, Fed was slightly delayed in terms of increasing their interest rates, thinking that inflation is transitory in nature. Probably that small delay that they did pushed inflation up ahead in terms of the up cycle. So what we expect is again inflation to continue being higher than their general average. So we are in an uptrending kind of a inflationary scenario. What we expect is again looking at these numbers, probably a 12-year cycle is what we are expecting. Again, this is a big question mark. We don't know that how many years this inflation will continue to stay in an upcycle, but we are expecting, given these numbers and the understanding of cycles that we have till now, probably we should see another, we should have upcycle in or uptrend in inflation till 2030. If that happens, you have to have, first and foremost, you have to diversify globally. And the second is obviously you have to hedge against inflation. These are the two major things that one needs to do. The general idea here is that from a longer term perspective, a good hedge against inflation remains gold. But we'll come to that as well, that how we are allocated there. So again, first and foremost, I can't stress this enough. You have to be in quality companies, because this is that cycle that we are in. If you're stuck in a non-quality, despite growth, if you're stuck in a non-quality, poor growth and highly valued company, then this is not the time to be there at all. Then the pain will be quite large. If you take care of quality, the remaining portions, if they fill themselves up, then I think the journey is much more smoother as such. So that's cyclical inflation. This has been our outlook since the entire year. So basically, in India, we've kind of went slightly neutral post tariffs, in April. But once we did not have a deal with US after that 90-day period was over, we kind of moved to a neutral position. We still don't have a major trade deal as well, but we're moving towards it. Given that liquidity again is driving and valuations look attractive in India, we moved back to slightly overweight. In US, we didn't expect liquidity to continue this long, given that the inflation was already above Fed's target. So we did not expect them to continue with loose monetary policies and bringing in liquidity. So that's where probably we missed out on a larger portion of their rally. But given the dip that we've seen because of valuation concerns, the dip that came in the last month, we've started increasing our weight in US as well. Given that they cannot, what we realized between June to November is that you should not just fight the central bank. There's no use fighting the Fed. If they want to bring in liquidity, you just have to go with the flow. The day the liquidity tap slows down, I think that day is the time that we should come back, back to a underweight scenario in US. Given all of this, again, Europe, across time, we've seen that Europe has moved back into their business cycle. So we're not very positive in Europe. China, we continue to stay neutral. We went neutral in August as well. So we continue to stay neutral. When you look at their business cycle, this is just coming out from that contraction zone back into expansion zone. So we just wait for another maybe a month or two to see how China is reacting and maybe then increase weights there. Japan as well, we saw that they have pushed themselves back into an expansion zone. So there we've kind of used the dip in the market in November to increase our weights in Japan as well. In terms of sectors, we kind of remained underweight IT. We've never overweight across the year. Post tariffs, we kind of reduced our weights. Once we went neutral in India, we kind of started removing out money from IT as well. So across this year, I don't think we've looked at IT from that lens of being an investment zone. Given right now as well, given post the fall in kind of in the IT sector, the fall that we had, the H-1B visa issue that came across, and you had that large dip of around 8% in a week. Post that, we started looking at the IT sector. Now we built some bit of conviction, but still the conviction is not as high as the ones that are there in other sectors. Over the last 2 months, what we've done is that post the new GST regime, we've increased our weights in the consumption story in India, where we are become like quite overweight on the durables, the realty, and the staple sector. Um, Autos, we were kind of slightly underweight, given that again you had tariffs and auto ancillaries were not kind of looking that great, but we were very selective across time. We've said we were very selective on the domestic names in India. We found those domestic names doing quite okay in a market which has been volatile, and we continue to build more conviction around the consumption story. We also uh, we also saw record high vehicle sales, passenger and commercial vehicle sales in the festive season. So that increases our conviction on at least those, at least the sector, auto sector, and other consumption sectors as well. In terms of banks, we like public banks better than private banks, and this has been a story that we've continued to do across the year. And why we've done that is something that we would go into just in a bit. In terms of debt, we had a rate cut yesterday. I think the only country, or the country with such a high real rate, is India at this point of time. So if you look at, let's say, inflation, which is around zero point 0.3, and if you look at policy rates, which are 5.5, you almost, you have this real rates which are around 4.5. Across the world, I don't think any country has real rates around 4.5. So with that, it becomes very difficult for a country to grow if the real rates are very high, because your capex kind of becomes very difficult to grow. So what we expect is, again, yesterday's 25%, 25 bips was a start in terms of reducing interest rates. I think given that consumers have been given boost by the by the fiscal policy, I think monetary policy has to follow up now, and we could expect kind of larger, or the continuation of rate cuts going into the new year. That should be the story, because we really need to bring down that real rates for India to continue or maintain that 8% plus GDP growth possible. So with that, we are considering bonds at this point of time. We this rate cut is probably the start. Till now, we were using another entity as bonds, and the other entity was basically gold. So now, probably going forward, we would consider maybe adding on to bonds rather than adding into gold. So this is how we kind of wanted to position ourselves. We wanted to position ourselves away from bonds, and for that we were looking at a protection asset. The protection asset continued to be gold till now. The general idea here was that gold was probably acting like a new bond, while a lot of people were losing faith in governments across the world. They found solace, or they found peace in investing in gold. So there's this general story that this is bond inverted bond yields. Basically, the numbers here are like positive on the downside, and this is gold in USD on the normal curve. So the idea here is that when bond yields kind of start reducing in in US, so when bond yields reduce in US, your gold prices go up. When bond yields increase, then is the time that gold kind of cools off. But that entire idea was broken in kind of the Ukraine-Russia conflict that happened in 2022. Bond yields have continued to rise in US, while gold has taken almost had a takeoff. So this correlation kind of broke. The minute we realized that this correlation is kind of breaking, that is when we placed ourselves kind of in the gold bracket. We went overweight in gold at the beginning of 2024. Now we think that probably this correlation may just start coming back. There are chances that this correlation again could start coming back. But generally, your metal prices, the demand and supply, when there is a mismatch, there is a large portion of there's a large buying that happens when there's a demand mismatch. So we can accept that there is a large demand gap or demand supply gap in industrial metals like silver, copper, and others. While the move in gold is largely because the idea was that the central banks are buying and trying to move away from the dollar and US bond yields. So given all of that, there was a large demand in kind of in gold. Now, if Fed can get their act together and try to protect or try to if the dollar starts to maybe strengthen some bit, it has lost value from 110 at the beginning of the year. The DXY index that went from 110 to 99. It is now trying to find some bit of strength, maybe for a move back above 100, back to let's say 100 to 103. During this small period, probably bonds would start making some bit of sense ahead of gold for the next round of when we start talking about de-dollarization part 2. That is when again I think looking at gold would make sense. So again, from a longer term perspective, if we actually look at gold bull runs, this is the bull run from 1970s. I think that bull run gold made quite a bit of high. We are halfway there, like this particular bull run that we expect. So that 1970 bull run was a 10-year bull run. This 2000 bull run is a kind of a 30-year bull run. So when we kind of combine that 10-year into that, like compress this 30-year into that 10-year period, we see that almost there is a correlation or there is a very similar liking between how gold moved back then and how gold moved right now. So we just there. I think a larger move is remaining in gold. So if you are investing in gold, think of yourself again. Think of the time period, and we kind of keep getting these questions that should I invest in gold or not? If you're investing in gold, think of the period that you want to invest for. If you're kind of investing for the next 1 year, then probably bonds would make a much better sense than being in gold for your protection thingy. If you're investing for the next 5 years, it gold has a kind of, it looks like if we compare it between 1970 and now, it looks like that gold has the kind of a larger move remaining as such. So for that interim period, maybe move to bonds, and post that, once again you have that de-dollarization part 2 come through, then moving back to gold would make a lot of more sense. And this is how this is how they've kind of performed. We're very positive on public banks ahead of private banks. That call has gone well. We're positive on the infrastructure story of India and metals. Those have kind of returned well. We were underweight IT across the year, so that's not performed, and that's been good for us. We've never looked at IT. We're just probably beginning to look at IT now. Still yet to add anything majorly in the IT sector. One place that we've kind of missed out, or where we've not been able to generate returns, is we're also positive on energy across the year. Energy is where we've kind of not our bets in energy have not taken shape. However, we continue to be kind of positive on energy, given that if there is a drive across data centers in the world, there's a large consumption story happening in energy as well. So I think the demand supply gap that you see in metals now would probably start playing out in energy as well, where there would be a demand supply gap, and that should raise prices for your electricity consumption going forward. We continue to remain positive of energy. It's just not played out this year, but given where we are now, we expect it to play out next year. And this is basically, there was a cyclical trade that we kind of did in terms of looking at public units ahead of private units. So when we compared PSU banks with Nifty banks, we could see that there was a cyclical low that was going through, and we continue to remain positive on public banks. That's it. Yeah, sure. So I'll just take that question first and then kind of move ahead.
Hello.
Hi, Deep.
So Karan, there's news on this government shuts doors on FDI limit merger chatter. PSU bank rally will be now on hold. And other part is like US dollar, it's going up. So I guess any point of time it can again like crash or go down because of this high inflation rising at US.
Sorry, I didn't
And
get the first part of the question. You said FDI in public banks?
PSU, yeah,
Yeah.
public banks, they have shut door for that on FDI limit. They have put cap on that
Yeah.
news recently.
Uh, uh, there is another major play here. If you go back and check that, the Nifty Bank Index itself, the larger players in that Nifty Bank Index are HDFC Bank and ICICI Bank. There's a rebalancing that is going to happen. The new rule says that no index should have more than 10% of a particular company. At least the banking index is where they're starting from. And when we kind of look at Nifty banks, the Nifty Bank Index, they're the larger players, which are HDFC Bank and ICICI Bank. They've got a very large percentage in there, and I think SBI is the third most, which is around 9.2%. So the idea here is that if the weightages of those banks come down, HDFC Bank and ICICI Bank come down, then they will kind of shift into your public banks. Why that FDI thing does not make sense is for us at this point of time is that despite whatever that limit was, hardly there was any investment by FDIs in or FIIs in public banks. The largest I think was in Canara Bank, which was I think around 11%. There was some certain banks which had 0% of FII interest. So for us, that FII story anyways did not hold up. Increasing limits there beyond certain point did not make any sense to us because we were not breaching limits at all. So that's not the point that we are looking at. We are instead looking at rebalancing in the bank index itself, where there is a chance that there will be a 10% threshold for every constituent, and that would make money probably move out from your larger private bank players to other banks in that index, or maybe addition of new banks as well. The second part of your question was basically on de-dollarization. The question on de-dollarization there is that from a longer term perspective, I think, dollar should probably lose more value than it is. It is quite strong at this point of time for me as well. But given that markets do not kind of move in a straight line. So you don't have a fall like in just one go. So after a large fall, like a 10% fall in the value of dollar, it's just taking some bit of stoppage right now in terms of trying to find that little bit of strength. I don't think this strength will last for a long period of time. Again, it's anybody's guess as to how long will this strength last. Maybe 2-3 months, 5 months. It's like I don't know till when it will, but we should continue the fall in dollar once this small period of strength is over. We expect dollar to start losing value again.
Thank you, Karan.
Thank you. Okay, just taking this last bit here. Avoid leverage and speculation, because those start affecting you in a different way. If especially companies which are levered and speculated, those are the ones which have very weak balance sheets. Trying to avoid them in a period of choppiness is one very good way of, because we're not in a trending market. We are kind of in a very steady, choppy kind of range bound kind of market. We're not in an explosive market, and we expect to say, let's say, continue for a few days more before some explosive moves start around there. So till right now, the position has to be in quality, and be very selective in consumption as well. Consumption, we've gone overweight in consumption, but again, be very selective there. Do not invest in companies which are highly levered or highly speculated within the consumption basket as well. Instead, there are very good quality companies which have valuations which may look high as well right now, but if you look at their history, kind of those large those players which are well known in the consumption space, over the last 3-4 years, if you look at their valuations have never been this attractive. Although in terms of when you're looking at in terms of price earning or your basic, valuation matrices, those may look expensive, but if you look at the history, these kind of companies have never been available this cheap. So be selective in your consumption story. Don't go for very speculative names there as well. If the company has quality, I think in a choppy market, quality outperforms your growth or valuation. We did get a few questions before, and that was this rupee question that we had, which was that rupee is touching 90 now. What do we think? Rupee touching 90 is like kind of is something of by nature. So till the time, so generally there is this. So in finance, there is this rule, which is a country with a higher interest rate should generally have a depreciating currency. Why? Because more and more the differential between the so there is an arbitrage trade that is possible. Again, we won't go into that very basics of arbitrage trades, but given that a country, if it's going up, like if it's at a higher inflation and a higher interest rates, then your currency should kind of depreciate over time. And this has been the story for India as such across time. So we while these cycles in India have become smaller, uh, we feel that these hardly matter as such. So moving from 40 to 50 took 10 years, 10 months. From 50 to 16 took 4 years and whatnot, and 80 to 90 has taken 3 years. While these kind of charts had in particular create a lot of panic, one has to realize that moving from 40 to 50 was like a 25% move. Moving from 50 to 60 was like a 20% move. Moving from 80 to 90 is a 10% move. So if you're looking at a 20 kind of 20% move across 4 years, then moving 10% over 3 years means that rupee is kind of much more stable and has much more strength rather than weakness. So we're looking at from a very different lens as such. We're looking at from a lens of strength rather than a lens of weakness. The idea of strength comes here from the fact that we don't think that dollar has too much value going forward. So this small bit of section or this few months where dollar probably shows a bit of strength, that is where I think that rupee may find some bit of weakness. But once dollar starts losing value again, I think rupee should kind of strengthen back into it. These headlines numbers like 90, 80, etc., create larger panics without people realizing that the percentage move in the currency is lower. So you're moving from a very high base to a higher base. That means that the percentage depreciation was much lower. Um, so last time that we were here, and everyone again, just to bring this to kind of a conclusion as to, again, it's a very choppy market. So our portfolios are not going up while the main index is kind of hitting all-time high. This is last time that we were here on map. We're trying to kind of come back into this demand zone and trying to test this demand zone out. At that point of time, if you remember, prior to that last month, we were here and we expected this was a supply zone at that point of time. We expected this demand zone, this supply zone to kind of be taken out and then become a demand zone. So that is what kind of happened. We till the last month. So this supply zone became a demand zone, and now we are kind of being, like, if you look at now we are right there in the yeah. So this is where we were kind of been bouncing around. The idea here is probably we should go and test the demand zone once more. Again, too early to say. Even if we do, so that's a move from 26,100 or 200 to 25,650. So then from a broader, from the main index, it is like a fall of around hardly 1% or 2%. While on the upside, once and this demand zone should hold on because it's already been tested once. It as a supply zone, it was tested multiple times. As a demand zone, we expect this demand zone to keep holding up. And again, we've continued to hit this supply zone quite again and again. So maybe just going forward, maybe one more test of this demand zone before we take out the all-time high supply zone, which is where kind of your movements would start taking place. Again, the number of times that we've heard this, despite all the positive news in domestic front, market is range bound for a very long period of time. What we believe is that market is trying to take out those people who are not convinced that an all-time high is coming in the markets or in the broader markets. It's just testing more conviction rather than kind of creating issues. So again, at this stage, while portfolios may be bleeding, etc., if you're in the right sectors, your portfolio would be stable, more or less stable. If you're on the wrong companies, highly levered companies, or the wrong sectors, then they would be bleeding quite a bit. But again, at this stage, what we believe is the market is testing out conviction more than being weak as such. We're not seeing any kind of weakness in the market at this stage. Given where we are, again, a lot of times we are asked about performances. This is over the last from April to now. This is how our portfolios have behaved. And in terms of comparing with Nifty, we've kind of outperformed a longer, like Nifty from a longer time perspective. In terms of gold, while we were quite ahead, given the recent run up in gold, some of our conservative portfolios have kind of have gone down because they have this equity component as well in it. So given that equity markets haven't moved or have been range bound in the last 14-15 months, we've kind of some portfolios have not performed against gold. However, once equity market starts picking up, we expect again to be back again above gold as such. Again, these are performance over a market cycle. Do not expect similar returns in the future is what I think is a mandatory disclaimer that we have to put in. I think I'm done with my presentation. Any questions that we can take? Deep, go ahead. I think thank you for an engaging session. It was fun answering all the questions. The questions that were asked around here right now were basically very similar to kind of us getting very similar questions across the last month. Again, I'll reiterate what we believe is the market is testing conviction rather than being largely weak over this period. So the idea here is basically how convinced is one when it comes to whether new highs will be seen in the market or not. We are pretty much convinced that we should be able to see new highs. When is the question? Maybe it can take another 15 days or another month or another 2 months. Till that time, maybe portfolios remain range bound or stable. For that, be invested in quality. Do not be invested in poor or weaker balance sheet areas, because weaker balance sheets get hit the hardest when the market is range bound. So while if you want to survive this till the time that the markets reach an all-time high, be invested in quality, and that is what we are kind of doing, and that's what kind of keeping our portfolios and our client portfolios stable as such till now. Once I think, and one has to realize that if your portfolios are stable right now, you're probably in the right sector, in the right companies, so that once the market starts moving up, these are the portfolios and these are the companies that would kind of start delivering returns faster than the other ones which have weaker balance sheet as well. So with that, I think thank you again for everyone for attending this. I hope it was useful. And if there are any questions, I'm available as well. And the team here at LLama Research is available to take your questions anytime that you have. Thank you again. Have a good weekend ahead.